Hello and welcome to Accredited Real Estate Schools. This is our first quarter 2023 real estate update. I'm Brian Church, and let's get started and see what we think's going to happen in the first quarter of 2023 relating to all things real estate. So let's go ahead and first thing, and there's a lot of things on investors' minds right now, and one of the biggest ones is inflation. So we'll start with that one. So inflation is the most important topic on investors' minds, just like I just said, right? And going into the first quarter of 2023, the Fed has increased the targeted short-term federal funds rate. What that means is that's what the short-term rates are supposed to be when banks borrow between each other, but they don't actually do that anymore, but it's targeted. So that's what they've been using for years, and they'll continue to use it. And it's from 0% to 4.75% in a year's time, is expected to increase up to 5% in March. And what was happened is that they're probably going to have a quarter point increase in February, quarter point in March, and be right around 5% is going to be what they call a targeted rate. Real estate prices tend to decrease when interest rates increase, at least initially. With inflation, remember, real estate tracks inflation quite well long term, but short term, you can have decreases in property prices. Home buyers can only qualify for a lower purchase price due to wages not moving upward at the same time. If the Fed pivots, which that's the term that the Wall Street's been hoping for all of 2022, if they pivot and instead of raise interest rates, lower them early enough in 2023, they may be able to keep the U.S. out of a severe recession, stabilize the real estate prices at the same time. And let's talk a little bit more about that because it looks like the Fed can use a couple of convenient excuses to change course to do the pivot from raising the short-term federal funds targeted rate to lowering or pausing it in early 2023. So the quandary that Jay Powell has, the chairman of the Fed, is whether to continue raising rates and not make the same mistake Paul Volcker did, called the Volcker mistake. But we're going to have to see what transpires on that. First excuse is the U.S. Bureau of Labor Statistics, or they're called the BLS, overstating new job creation by over 1 million jobs. No kidding. Actual job creation was around 10,000, but they stated they had 1.1 million. A little bit off on the numbers, I'd say, like way off. And we don't accuse them of any, election time mistakes on that one, because we don't talk politics or religions. Two things we don't talk about here on our update. Second excuse is the Fed's discovery that the numbers they've been using to calculate the CPI are 4 quarters too late. Now, this has been common knowledge for a long time with investors. We've known about this forever. They're always behind the curve. We use the run-of-the-mill everyday real estate websites to make forecasts because the data is more current and accurate, meaning that rents, we can figure out what rents really are based on, websites that are out there. There's a whole bunch of them that do it. And the stuff the Fed's using is outdated and it's not accurate. It's about a year behind. Savvy investors have been very skeptical of the government provided CPI numbers because they've been using rents from existing residential housing instead of rents from new tenants who recently moved into a property. So the new tenants are more indicative of what is going on in the market. And the existing residential housing that the Fed has been using is not indicative. And this is a far better determinant of the current overall residential real estate market is the new rents. Existing housing rental numbers run around 4 quarters behind the actual rental market, so the Fed's actions have been consistently too late for quite a while. We've known that for a while. Well, in response to this deficiency, the Fed has come up with a new tenant repeat rent index that will be more indicative of the overall rental market than their existing all tenant repeat rent index that looks at existing rental rates and not rental rates for new tenants. And what's happened is that they have realized that they're 4 quarters behind and everybody has access to these really basic websites that have better data than they do. And so they're finally starting to look at the new tenants that come in. Now, both of the indexes use the term repeat rent because they use rents from the same properties as they're rented to a tenant, become vacant, and then are re-rented to another tenant, and the process repeats itself. The all-tenant repeat rent, ATRR, uses existing rents for tenants who are living in the property, while the new tenant repeat rent uses new leases that have been recently renegotiated and provide a better picture of the current rental market. So the numbers they have coming up now are going to be a little better. They're actually starting to figure it out. The, the Fed's existing ATRR is even more incorrect because there's good evidence to show they're using data from subsidized rents, like the old Section 8 that they call the Housing Voucher Program now, under the Department of Housing and Urban Development, which is HUD, instead of unsubsidized market rents. Real estate investors who have experience with subsidized tenants know they're usually a bit under market and will make the CPI numbers even further off. So they've been using the easy numbers to get, which is the subsidized stuff, and that's why they've been off before. So they're using old data and they're using stuff that's easy to get but not accurate. So that's why investors have known this forever with the CPI. And so what the researchers do not seem to understand is that when rental rates increase, tenants tend to stay in the property they're renting and not move elsewhere because landlords are typically slow to raise rents on existing tenants. And that's very true. Many landlords realize that increasing rents is a good idea when rents are increasing. However, they also understand that raising rents can cause tenants to move out. Then the landlord is stuck renting the property to a new tenant with the costs of vacancy, repairs, etc., possibly being more than if the landlord had not raised the rent in the first place and kept collecting slightly below market rents. These types of properties are common and will skew the CPI rental numbers downward during a tightening residential real estate rental market when rents are actually increasing. So what basically we're saying here is that the landlords don't raise the rents, and the rents that you have for existing tenants that are not new rents are going to be lower than what the market is. And sometimes they'll go the other direction; it could be higher too. But in this case, with inflation kicking in, they'll be lower. The reason the NTRR is so important is that 32% of the CPI basket of goods is represented by residential housing. So nearly a third of the CPI index has been consistently 4 quarters behind in economic forecasting. Hopefully, this will give the Fed the impetus to stop raising interest rates before the U.S. economy is destroyed by the outdated financial models that they're using. And thus, the Fed pivot is now more likely to happen in early mid-2023. Well, that's what everybody thinks that they might have to because they're going to destroy the economy. They've been using these Phillips curves, but all the hedge funds and anybody are using complexity theory. So there's a lot of difference that the Fed is just not getting. And that's why they have been wrong on every call they've made. They're always behind on everything. And investors have been trying to front-run the Fed for so long, and now they're trying to get out of their way. The NTRR indicates that residential rents peaked in mid-2022, and they started actually declining during the fourth quarter of 2022, and that's nationally. So in certain markets in California, that will not be the case because of such a strong economy that California has. Instead of the U.S. economy continuing to heat up like the Fed's existing lagging numbers indicate, the residential rental market now is actually cooling off, and of course, that's in a lot of markets. Add this fact to the Fed misdiagnosing inflation as coming from a demand pull, which of course from consumer demand rather than from cost push inflation. It's caused by increasing energy costs pushing consumer prices upward. And as the U.S. economy is crushed by increasing interest rates, consumer demand will decrease, providing the Fed with a lower inflation rate. Unfortunately, this will come at the cost of an economic recession in the U.S. And all the people you talk to now, economic advisors, are all not saying if the recession, is just when. So probably going to be a stock market adjustment as well as that. Fed Chairman Jay Powell does not want to make the Volcker mistake. Paul Volcker was chairman of the Fed from 1979 to 1987, and as inflation raised its ugly head, he started raising interest rates, which is what that's what the Fed does. However, political pressures caused him to reverse course and lower interest rates for an extended period of time. And the Volcker mistake is that he reversed course too soon. Inflation returned with a vengeance. Jay Powell does not want to make the same mistake Paul Volcker did. Therefore, even with incorrect job numbers and the new CPI indicator, he may still continue to raise interest rates to avoid the Volcker mistake. So he might not follow the pivot. He might not do anything because he does not want to make the same mistake that Paul Volcker did. And so if this occurs, he will likely raise probably 0.25% February, 0.25 in March. it'll be right around 5% or so. And they're calling it the terminal rate. The Fed's calling it the terminal rate. And if this rate is kept the same for an extended period of time, they're calling it a pause. He hopes it will tame inflation on its own without the Fed having to do anything else. Volcker had to raise interest rates up to 20% to break inflation. Powell does not want this to happen again. So they did learn a little bit about Volcker back when the interest rates were that high. And so that's what we're dealing with right now is everybody says, well, we need to pivot and save the economy. But it looks like we may not, we may have a pause coming up here. And we're hearing almost maybe as long as a year on that pause. So we'll see what that's going to transpire. Therefore, the big question is whether the Fed is presently at the terminal rate now or only needs to sit tight and watch inflation numbers decrease over time, or does the Fed need to keep raising the targeted federal funds rate to reach the terminal rate? Following three charts indicate that he's already there. And the first one here is this new tenant repeat rent and all tenant repeat rent index. And as you see, the all tenant one is pretty flat, whereas the new tenant one showed a really, really big increase and then a really, really big decrease going on. And again, it depends on the market, though. These are national numbers, and some of the other markets are so strong that it just doesn't matter. But this is what they're looking at overall. And then we also have the S&P Core Logic, the Case-Shiller stuff. Now, what they do here is they look at specific markets. There's a 20-city index that they use, and they compare the same house over a period of time as it goes up and down in terms of the prices. And right now we're seeing a big down on the prices because interest rates have been increased so much, affordability is down, prices will therefore drop. The question is how long this will occur and how far it'll go. And then we have the pending homes, and as you can see, the index year over year is down quite a bit on pending, stuff that's pending but not closed yet. So based on all that, we're looking at a real down real estate market nationally. California, fortunately, has really strong economics, so they typically weather these better than some of the other markets that don't. And so we're just hoping that that's the case here. It should be noted that leased investments may be affected by the new tenant repeat rent index. If annual rent increases are tied to the CPI index using the NTRR, the new one, inflation will be measured at existing levels rather than lagging by 4 quarters. This will provide property owners with a better measure of inflation and allow them to increase rents sooner than they would with past lagging data. As the inflation rate starts to decrease, it's called disinflation. And if there's too much disinflation, in other words, the Fed overshoots and tightens too much, then it could turn into deflation, which is completely opposite, where the dollar is actually worth more in the future. If this occurs, leased investment property owners may want to consider fixed rental increases instead of tying them to the CPI as lease expire and are renegotiated in the future. What this means is that if you're own a leased investment, office buildings, shopping centers, I know they're having a rough time right now, industrial properties, anything with a lease and it's tied into the CPI for inflation, you might want to use the new index because that's going to give you a better idea of what this actual CPI is. And if it turns into disinflation and deflation, then I would go in with fixed rent bumps and rental increases so that they're going to be staying this. You don't tie it into the CPI because you're going into deflationary. So you still get your ups, but not tied to the inflation. So there's going to be a new number for the CPI. So anybody with leased investments should really look at that because it'll help them stay with what's really in inflation. Because remember, the idea of having these rental increases with inflation is just so you stay even, so that your rent's coming in are at least the same as when you started because of the inflation. Another thing that is not on investors' minds, but should be, the U.S. is coming out with its own central bank digital currency, and there's actually a 12-week trial occurring right now in the U.S., and if it's successful, the U.S. could be rolling out a digital currency in the very near future. This will force consumers into a digital currency that will do away with physical cash. This sounds like a good idea. However, it will allow the U.S. to impose negative interest rates in an attempt to get people to spend their money and increase the overall velocity of money. The present government thinks this will increase GDP and reduce the debt to GDP ratio. So what's happening is that they get you into this central bank digital currency, and there is not any physical cash out there, then they can force you to spend the money because you don't want to leave it in there, and you actually have negative interest rates. You actually be losing money as you leave money in there. There's some talk that the Fed might actually set up accounts directly with the Fed when they do this. We thought this was a few years out, but all of a sudden this trial came out, and this may be coming sooner than we thought. So that's why we're concerned about that here with our update. On the other hand, the U.S. federal government likes inflation because it allows the government to pay back the national debt with cheaper inflated U.S. dollars. So the federal government's trying to reduce inflation, but at the same time, it's their best interest to keep inflation higher so they can more easily pay off the national debt and incur more debt because, after all, politicians do like to spend money. And boy, do they. That falls into the modern monetary theory, which a lot of the politicians are adhere to. They don't even know what it is, where they think they can spend as much money as they want, they can print as much money as they want. It's all digitally, of course. And then if there's a problem, then all they do is raise taxes to stop inflation. So that's why I think they want those 87,000 IRS agents to try to increase taxes, thinking that's going to happen. The whole theory is misguided. It's not going to work, and all they're going to do is just mess things up as usual. So again, we're just trying to stay out of their way, be in the right place at the right time. U.S. recession, and there's also a possible global liquidity crisis coming too, as well as a recession. So U.S. is looking at a recession hitting in early 2023, along with a global liquidity crisis. Banks and other institutional investors are scrambling to obtain good collateral to prop up their balance sheets. This is the same thing that happened in 2007, just prior to the 2008 housing crisis. Now, you got to remember back then, though, the housing crisis was put together because Wall Street and a lot of the shadow bankers and the bankers, even Fannie Mae and Freddie Mac were involved in it, where they were making loans to people who couldn't afford to pay the loans back. And they're not doing that this time. That's why instead of selling everything like we did back in 2007 and 6, and then waiting and then putting the money back in the market in 2011, this time a lot of the investors are not just holding tight because they don't see as big of a down as they said last time. But this still could be a market down that could occur, especially the stock markets. And of course, most of the investors in there are going out of there and going into tangible assets. The ones that are using, of course, the residential real estate. They're not going to commercial especially shopping centers and office buildings because of the situation with big box retailers having real issues with the online for retail, and then office people working at home. So they've had those two product types people are staying away from, but they're going into the residential end of it, buying a lot of residential stuff. Also, a lot of people buying precious metals, gold and silver, thinking that 2023 is going to be a good market for them as people do a flight to safety, and probably I can agree with them on that one. So tangible physical assets tend to be good. Anyway, that's the end. That's this Accredited Real Estate Schools. I'm Bryan Church. This is our first quarter 2023 real estate update on what's going on from a macro standpoint. Real estate prices have started coming down, and we're still waiting to see what's going to happen. But as we go into the second quarter of 2023, we'll have a next update, and we'll see a lot more of an idea of what's going on. And thanks for listening.